Welcome to the El Salvador SV News Podcast, a space for conversation and reflection where we explore current topics from El Salvador and the world together. You can support this project via PayPal. You'll also find details in the description of this content, or by purchasing digital content of products you might like. Check out what interests you and make a purchase. With that, you help and support us to continue providing content. You'll find all the methods in the content description. Find us on your favorite platform, on Spotify, Amazon Music, Apple Podcasts, TuneIn Radio. We're on almost all platforms as Noticias El Salvador SV.
Welcome to the Deep Dive. We are looking today at a truly monumental stack of sources. We've got global financial reports, we have critical macroeconomic data, some really complex political reforms, and even high-level global security intelligence.
It's quite a mix.
It is, and our mission really is to take all these seemingly disconnected events, everything from job numbers in the United States to crypto performance all the way to power shifts driven by AI, and try to figure out how they connect.
To find the through line.
Exactly. What is the single coherent story that sort of defines the global risk environment right now?
It is a genuinely complex tapestry, as you say. I mean, we're dealing with this pervasive ambiguity in the financial markets, and that's happening right alongside these fundamental structural changes in geopolitical power. It's a lot to get a handle on.
So where do we start? How do we anchor this conversation?
I think we have to start with the source of so much of this global uncertainty, and that's the monetary policy puzzle centered around the United States Federal Reserve. Specifically, the very ambiguous signals coming from the United States job market.
That feels right. Global finance, at the end of the day, still turns on the axis of the Fed's decision-making.
It absolutely does. And once we clarify that base level of monetary uncertainty, which I think we'll argue is a state of weakness but not collapse, we can then transition right into one of the most revealing stories of the year,
which is
the dramatic divergence between the performance of gold and Bitcoin. It's a story that has challenged, every assumption we had about safe haven assets.
And then from there, we pivot pretty dramatically. We're going to move from high finance to these very tangible on-the-ground developments, looking at governance and infrastructure, specifically examining Central America's unique approach to security, digital assets, and how it's trying to overcome some very deep economic challenges.
And then finally, we'll broaden the scope out to global security. There we'll see traditional state-on-state conflicts escalating alongside a completely new kind of threat landscape, one that's being defined by technology, by algorithms, and this shift in power away from governments.
A full spectrum analysis of modern risk.
That's the goal.
Let's dive in. Okay, so let's start with the markets. Let's unpack this. The reaction to the latest employment data in the United States was, it was one of profound caution. The S&P 500 recorded its third consecutive day of decline right after that November labor market data was released. That, to me, suggests some deep investor uncertainty about where the economy is really headed.
That caution is entirely rational. It's actually the smart reaction once you look past the headlines and, drill down into the core data points.
So what did we see?
Well, first, non-farm payrolls. They increased by a relatively small 64,000 jobs in November.
64,000. For an economy the size of the United States, that feels anemic.
It is. And critically, this follows a much sharper and frankly an alarming decline of 105,000 jobs in October. So you have a drop followed by a very weak rebound.
Okay.
And at the same time, the unemployment rate experienced a pretty significant spike. It rose to 4.6%.
A jump to 4.6% in unemployment. That's the highest level we've seen in the United States since 2021. Historically, that kind of number demands an immediate, forceful response from the Federal Reserve. It just screams weakening demand.
It's an alarm bell.
So why isn't the market immediately pricing in aggressive rate cuts? That's the puzzle.
And here is the critical nuance.
Yeah.
This is what turns it into a genuine puzzle for traders and for us. The report is, it's universally described by analysts as noisy or contaminated. That spike in unemployment, those choppy payroll numbers, they were significantly distorted by temporary political factors. Specifically, the major contraction in federal employment that was related to what became the longest government shutdown in United States history.
Right. Let's explain that contamination for a second. For you listening, why does a government shutdown artificially noise up a labor report?
It comes down to survey methodology. The Bureau of Labor Statistics, when they conduct their survey, they have to classify furloughed federal employees. These are people who are temporarily out of work because of a lack of government funding. but they fully expect to return to their jobs, they're classified as technically unemployed during that survey window.
So it's a statistical artifact.
It's a huge one. It means that 4.6% rate is very likely an overstatement of the true, organic, structural joblessness in the private sector. It's a temporary spike driven by administrative politics in Washington, not by some systemic economic collapse out in the real world.
Which makes the data exceptionally difficult to trade on. It forces investors to decide which narrative to believe. Do you trust the historically alarming number, the 4.6%, or do you trust the context of political distortion?
And the market, for now, is choosing caution. It's choosing to wait. Despite that rise in unemployment, the very data point that would normally trigger dovish, rate-cutting expectations from the Fed, the swaps markets are only assigning about a 20% probability to a Fed rate cut in the upcoming January meeting.
20%, that is a stunningly low probability considering that headline unemployment figure.
It's incredibly low.
Just to explain, for those unfamiliar, swaps markets are where investors essentially bet on future interest rate movements. A low probability like that means they are willing to put significant money on the line, betting that the Fed will not act quickly.
Precisely. It signals a deep ingrained belief among traders that the Federal Reserve will not be fooled by temporary statistical anomalies.
They expect the Fed to look past the noise.
They do. They expect them to wait for cleaner data. However, if you zoom out a little further, the market consensus remains pretty fixed on the long-term view. A full monetary adjustment, meaning a cycle of rate cuts, is still fully priced in by mid-2026.
So the market acknowledges the long-term trend is toward relaxation, but it sees absolutely no short-term urgency.
We are stuck in limbo, and that's a very uncomfortable place for capital to be.
This limbo is, I think, perfectly reflected in the diverging analyst views, which to me provides a fascinating window into the current intellectual struggle happening on Wall Street.
It's a great illustration. The same set of facts can lead to opposing, yet equally logical conclusions.
On one side, we have an analyst, let's call them Analyst A, from Brandywine Global. Their interpretation suggested that the weakness in the report was sufficient to justify previously scheduled cuts.
Right.
They're arguing that even if you account for the political noise, the underlying deceleration in payrolls is real enough that the Fed should just proceed with whatever rate cuts they had already planned, rather than delaying.
So they see legitimate, albeit moderate, weakness. They're saying, don't get distracted by the shutdown. The trend is still down.
Exactly. But then, standing directly across that chasm, you have Analyst B from Goldman Sachs Asset Management.
A completely different take.
Completely. Their view indicated the Fed is unlikely to place any significant weight on these disturbed figures. They argue the numbers are just too contaminated by the shutdown effect to be reliable for making short-term policy.
For them, the critical data point won't even arrive until the December employment report is published in early January.
So their advice is complete patience. Wait it out.
It is. And this is a classic risk management debate you see inside any financial institution. Do you act on imperfect data to mitigate a potential crash? Or do you wait for certainty, but risk being too late, risk being behind the curve?
And it seems the Fed, and by extension the market, has chosen the latter. They believe they have the time to wait.
And that waiting strategy is, to be fair, supported by the broader economic context. We're still seeing continued consumer resilience.
The consumer is still spending.
For the most part, yes. Sales data for October showed very little variation overall. You saw solid consumer spending across several categories, which signals that the engine of the United States economy, the consumer, is still running smoothly.
Though it is worth noting, I saw that the solid spending was slightly offset by a drop in vehicle dealer sales.
Yes, and that's a key pressure point.
Cars, big ticket items, they're highly sensitive to interest rates.
Of course, and that's where you'd expect to see the first cracks appear. But the overall assessment remains unchanged for now. The general consensus is that this report was, in a strange way, positive for those who are anticipating a moderate policy path in 2026.
How so?
Because it offers absolutely no indication that the wider economy has been fundamentally derailed. It suggests stability, not an immediate crisis. It means the Fed can afford to wait.
So we have an environment that's really defined by this monetary caution, high real interest rates, and data that is just too noisy to trust. That subtle ambiguity weakness but not collapse sets a very, very complex stage for capital flows. Because when policymakers are cautious, capital seeks clarity somewhere else.
And that search for clarity in 2025 led to a complete reassessment of asset safety. It resulted in a fascinating divergence between the two most talked about safe haven assets. I think we should move to that.
Absolutely. This feels like the perfect next chapter.
If we connect that thread of persistent monetary uncertainty and those high real interest rates to the capital markets, 2025 really marks a massive divergence, a huge break in the performance of Bitcoin and gold.
For years, it felt like analysts just automatically grouped them together.
They did. They were proxies for distrust in fiat currency, or they were seen as hedges against geopolitical instability. Digital gold versus actual gold.
But in 2025, that coupling just broke.
It fundamentally redefined what investors value in a true crisis, when the rubber really meets the road.
And the numbers that illustrate this collapse in their traditional relationship are just staggering. If you look at the Bitcoin to gold ratio, which is just a measure of how many ounces of gold are required to purchase a single Bitcoin, it plunged, a jaw-dropping 50% in 2025.
50%, it's a massive re-rating.
It fell from roughly 40 ounces of gold per BTC in December of 2024, down to around 20 ounces by the fourth quarter of 2025.
This isn't just a minor market shift. It's, as you said, a fundamental re-rating of their comparative value in a risk-off environment.
It forces us to ask, what changed? What did investors prioritize when they were faced with genuine, elevated, tangible risk?
And what's so fascinating here is that this 50% ratio drop was not caused by a catastrophic collapse in Bitcoin. That's not the story.
Right. Bitcoin didn't crash.
On the contrary, Bitcoin still reached six-digit prices during the year. It's currently trading around $87,992. That's a strong performance in absolute terms by any measure.
So the story isn't Bitcoin failing. The story is gold succeeding on a completely unprecedented scale.
Precisely. It was gold's truly extraordinary year. Gold posted a cumulative gain of 63%.
63%.
And it decisively pushed past the $4,000 per ounce barrier. Now, this is the crucial point. This massive rally happened despite the significant headwind of restrictive monetary conditions.
The very conditions we were just talking about.
The very same. The United States Federal Reserve maintained elevated interest rates and only implemented its first tiny basis point cut in September. Normally, high real rates, they raise the opportunity cost of holding a non-yielding asset like gold, and that suppresses its price. But not this time.
So, if interest rates were actively working against gold, what was the structural demand shift that was powerful enough to overcome the gravity of the Fed's policy?
It was driven by dual forces. First, strategic sovereign buying, and second, institutional flight to quality amid spiking global risks.
Let's break those down. Central banks.
Central banks were absolutely key players. They led a massive diversification effort, adding 254 tons of gold to their reserves just up to October.
Which nation was leading that sovereign buying spree?
The National Bank of Poland was the real standout. They added 83 tons all by themselves.
83 tons.
And you have to understand, this isn't tactical trading. This is long-term strategic reserve management. What this tells you is that central banks are deliberately moving assets out of fiat currency exposure, out of dollars, out of euros, and into physical gold. It indicates a long-term anticipation of global currency volatility or perhaps geopolitical fracture.
And institutional capital, the big money, followed this lead.
Without a doubt, global gold ETF holdings experienced enormous growth. They expanded by 397 tons in the first half of the year alone.
Wow.
And they reached a record 3,932 tons in November.
And this massive inflow of institutional money, it coincided with a measurable spike in global anxiety, right?
Perfectly. You can track it. The VIX, which is the index of volatility, often called the fear index, it averaged 18.2 in 2025. That's a noticeable increase from 14.3 in 2024.
So the background noise of fear got louder.
It did. And even more telling, geopolitical risk indices, which track global conflicts and tensions, they increased by 34%.
This makes the implication crystal clear. When actual, tangible geopolitical risk materialized, gold acted as the ultimate broad portfolio insurance.
That is the essential takeaway from 2025. And its status as an insurance play was confirmed by its market behavior. Its correlation with stocks reached the weakest level we have seen since the 2008 financial crisis.
So when stocks went down, gold didn't follow.
It held its ground or went up. In a high-risk world, investors prioritized gold's true non-correlation and its thousands of years of history over the narrative that Bitcoin was the new digital version of a safe haven.
Okay, but then let's flip to the other side of that coin. If gold was absorbing all that institutional anxiety, why did Bitcoin's relative demand soften in the second half of 2025, even while it maintained its high absolute price point?
It was a classic buy the rumor, sell the news situation, and it was coupled with that persistent drag of high real interest rates we keep coming back to.
Explain the buy the rumor part.
The initial enthusiasm for the spot Bitcoin ETFs, that was the big story. It drove assets under management, or AUM, to a peak of $152 billion in July.
A huge number.
But that momentum couldn't be sustained. AUM subsequently dropped to $112 billion. That reflects net capital outflows over those next 5 months.
So institutions got in, the price went up, they took their profits, and then they allocated that capital elsewhere.
That's a big part of it. The institutional entry that was supposed to provide a permanent floor for Bitcoin's price instead resulted in, well, more volatility and eventual net exits from those very products.
And what was happening on the network itself, the on-chain data?
Simultaneously, the on-chain data shows that long-term holders, these are often the early adopters, the true believers, they engaged in one of the most aggressive phases of profit-taking ever recorded.
Really?
They sold over 500,000 BTC between July and October.
500,000 Bitcoin.
When prices are high and the world is uncertain, even long-term holders will liquidate a portion of their holdings. That creates substantial selling pressure that the new institutional money just couldn't absorb.
And this brings us right back to the monetary regime. If the Fed is keeping interest rates high, the opportunity cost of holding a non-yield generating asset
becomes prohibitive.
Especially one that still, at times, correlates with tech stocks.
That is the central financial argument that drove that 50% compression in the BTC to gold ratio. It's all about opportunity cost. When interest rates are positive in real terms, holding cash or bonds gives you a return. Holding an asset that pays no dividend and no interest is costly.
So gold managed to overcome that headwind, but Bitcoin couldn't.
Because gold offered something Bitcoin couldn't in that specific environment: non-correlation and history. In a time of real geopolitical fear, it established itself as the genuine risk-off safe haven. Bitcoin, which still often trades like a high-beta technology play, failed to offer that pure insurance policy. The market's message was definitive. Gold remains the preferred hedge against systemic, physical geopolitical risk.
That distinction you just made, physical risk leading to a preference for physical gold, that's key, and I think it transitions us perfectly. Let's move from abstract financial risk to a region that is actively managing very real physical and political risk, Central America. Shifting our focus now to Central America, we are seeing a country undergo a profound transformation. It's marrying this intense internal security centralization with a very rapid, digitally focused economic development plan.
It's a fascinating and controversial model.
Politically, the Legislative Assembly there made a highly scrutinized move recently. They reformed the Constitution to extend the mandate of the Supreme Electoral Tribunal magistrates, the TSE, to 6 years.
This is a critical structural move. It's not just a minor tweak. The goal, at least publicly, is to synchronize the electoral cycle.
How so?
The new 6-year term aligns the tenure of the TSE magistrates with the presidential election cycle, which will start in 2027.
I see.
Now, there is a transitional 3-year period that ends in July 2027. But while this is framed as a measure for administrative and political stability, ensuring the electoral oversight body is aligned with the presidential term, it also naturally raises questions.
Questions about the long-term centralization of power within the state apparatus.
Exactly. When you consolidate control over electoral timelines and oversight, critics will always worry about the erosion of checks and balances.
Right. And regardless of those political mechanics, the government is successfully defining itself, at least internationally, by its security achievements. They're relying heavily on measures like the Territorial Control Plan and the ongoing state of exception.
And the measurable results of that strategy are, frankly, indisputable. And they're historically transformative for a region that was once one of the most violent in the world.
What are the numbers?
Authorities reported 289 days with 0 homicides in the current year.
289.
To understand the sheer magnitude of that figure, you have to remember the historical context. The decades of endemic gang violence, the instability, the fear. This represents a complete an incredibly rapid reversal of high-level criminality.
And global perception seems to be validating this approach, at least on the security front.
It does. The country achieved the highest global index score against organized crime in the Americas.
The highest in the Americas.
And it jumped 25 positions in the world ranking. This is external, third-party affirmation that the internal security strategy is succeeding in its goal of dismantling criminal structures.
We see that dismantling in the specific enforcement actions, too.
Yes, very clearly. We're seeing reports that entire structures of the MS gang have been handed down lengthy sentences, some reaching up to 280 years.
280 years.
That level of judicial certainty and enforcement effectiveness is often the absolute prerequisite for attracting serious, long-term foreign investment. Capital is a coward. It won't go where it feels unsafe.
And it seems the improved security backdrop is demonstrably generating that economic optimism you're talking about.
Absolutely. The United Nations Economic Commission for Latin America and the Caribbean, which is known as CEPAL, they revised and improved the economic perspective for El Salvador. They're now projecting a robust 3.5% growth in 2025.
And that's explicitly linked to security.
The report explicitly links that revised optimism to the new stability narrative. International bodies are essentially betting that security equals productivity.
And critically, this stability seems to be translating into large-scale, future-proofing infrastructure projects. The country isn't just focused on security for today, but on becoming a digital and logistical hub for tomorrow.
That is the fascinating dual strategy they're pursuing. For instance, construction has begun on the country's very first submarine internet cable.
That's a huge deal.
It's a vital project. It was selected by Liberty Networks, and it's set to be operational by 2028.
So for the listener, why is a submarine cable so critical for a developing nation?
Because it establishes a direct, high-capacity connection to the international internet backbone. It allows you to bypass regional choke points and unreliable terrestrial networks. This is absolutely essential for things like low-latency financial transactions, for attracting data centers, and for competing in the global digital economy. It's like building a new superhighway directly to the rest of the world.
And it's not just digital connectivity, it's physical logistics, too. I saw that construction of something called Air City has begun at the main airport.
Yes, and this leverages the country's significant geographical advantage. It has a central land connection with all of Central America, and it's just a short flight path to the United States.
So Air City is designed to be a strategic logistical node.
That's the idea. They're anticipating serving approximately 800,000 passengers in December alone. When you combine improved security, critical digital infrastructure like that submarine cable, and a major logistical hub like Air City, you are building a blueprint for regional dominance in trade and connectivity.
This, of course, naturally leads us to the unique financial structure the nation has adopted. They're not just building the infrastructure for the digital economy, they are heavily invested in it. The government confirmed it bought more Bitcoin, bringing its total sovereign holdings now to 7,502 BTC.
And at current market prices, that holding is valued at roughly $647.4 million.
That's a very significant sovereign stake in a decentralized asset.
It is. It reinforces their long-term digital vision. However, this is where that rapid development narrative clashes, and clashes hard, with the deep structural reality of the domestic economy.
This raises the crucial question of fiscal tension. How does a high-risk, high-reward digital asset portfolio counterbalance the immense tangible challenges facing the traditional labor and pension systems?
And the data on that is stark. The International Labor Organization, the OIT, provided some contrasting data that really highlights the immense challenge they face.
What did they find?
Their analysis suggests that 5 out of every 10 Salvadorans of productive working age are not actually working.
50%.
50% of the working age population is not formally engaged in the economy.
That is a staggering non-participation rate. Even with 3.5% economic growth, if half your working population is outside the formal tax and contribution system, the fiscal pressure must be immense.
It creates a severe demographic and fiscal imbalance. And that leads directly to the very serious and very difficult discussions happening around pension reform.
What's the scale of that problem?
The current pension debt accumulates to $2.72 billion.
2.72 billion.
Now, compare that figure to $0.72 billion in debt to the $647 million value of the sovereign Bitcoin holdings.
So the Bitcoin holdings, while they sound impressive, they cover less than a quarter of the existing pension liability.
Exactly. It puts the government's high-stakes digital asset strategy into sharp fiscal relief.
It's not a silver bullet.
Far from it. One pension expert explicitly warned that raising the retirement age is, in his words, a statistical necessity in the upcoming pension reform. So you have a nation that is trying to use security success and digital investment to leapfrog its economic challenges, but it simply cannot escape the hard arithmetic of its demographic structure and its unfunded liabilities.
It's a nation moving at two speeds. You have this rapid 21st century development layered over these persistent 20th century systemic fiscal challenges.
It's a remarkable case study.
And that tension between state control and decentralized solutions brings us perfectly to our final segment, where we're seeing those exact same tensions play out on the global stage with global security threats. All right, turning now to global security. The landscape here feels incredibly tense, with tensions remaining high, particularly around United States policy and its projection of power in the Western Hemisphere. We've seen rhetoric escalate dramatically, and that has been followed by direct kinetic action.
The rhetoric is, in some ways, a throwback. It feels like an echo of previous eras of, say, Cold War confrontation. For instance, we heard a very strong warning from the president of Belarus, Alexander Lukashenko.
A close ally of Russia.
A very close ally. He stated that he expected to discuss the tensions around Venezuela directly with President Trump. And he characterized a potential conflict in that region as, and I'm quoting, the Second Vietnam.
The Second Vietnam. Why that specific loaded analogy?
That phrase is deliberately chosen. It's meant to suggest an overextended, unwinnable proxy war against a regional power. A conflict that would drain resources, treasure, and public will, all without a clear strategic victory.
So it's a warning shot.
It's a rhetorical one, yes. It reframes the United States military presence in the Caribbean not as a simple counter-narcotics or stabilization mission, but as a dangerous escalation into a protracted conflict zone. And it signals to the world that Russia's allies are paying very close attention to potential interventions in the Western Hemisphere.
And this rhetoric wasn't just talk. The military response has been concrete. Joint Task Force Southern Spear, which operates under the direction of the Secretary of War, Pete Hegseth, carried out kinetic attacks in international waters.
Yes, and these strikes targeted 3 vessels that were identified as being operated by terrorist-designated organizations.
And they were involved in drug trafficking in the Eastern Pacific.
This is a significant elevation of counter-narcotics policy. We are seeing the direct projection of hard military power against non-state actors who are operating criminal supply chains in international waters. It blurs the line between law enforcement and military action.
The operations resulted in the deaths of 8 men, 3 on the first vessel, 2 on the second, and 3 on the third.
It signals a very clear policy pivot, a pivot where criminal activity that is deemed a threat to national security is now being met with immediate, lethal military force, not just interdiction and arrest.
This leads directly to another major policy decision that redefined a threat. President Trump signed a decree that officially classifies fentanyl and its chemical precursors as a weapon of mass destruction, a WMD.
This reclassification is not a symbolic act. It's a critical policy mechanism. It fundamentally changes the jurisdiction and the legal framework for combating the drug trade.
Let's elaborate on that mechanism. How does classifying a drug as a WMD actually alter the operational response from the government?
Well, by classifying fentanyl as a WMD, you fundamentally change the jurisdiction. You move the fight away from domestic law enforcement, like the DEA or Health and Human Services, and you place it squarely into the hands of the Department of Defense, the Department of Energy, and the intelligence agencies.
So it becomes a national security issue, not a public health or criminal one.
Precisely. It allows the government to legally utilize military and covert capabilities. Things like targeted drone strikes on foreign manufacturing facilities or intelligence-led disruption of precursor chemical supply chains. Actions that would be illegal or impossible under standard counter-narcotics laws.
So you're legally defining the threat as a foreign attack, even if the impact is felt domestically.
Yes. The president cited the catastrophic mortality rates, estimating 200,000 to 300,000 deaths annually from fentanyl overdoses, as the rationale. He's declaring its manufacture and distribution a direct threat to United States national security.
The context is stark. Just 2 milligrams can be a lethal dose.
The administration is essentially declaring a national security war against a synthesized chemical threat. It's a new kind of warfare.
And while states are grappling with these physical and chemical threats, there's a more subtle, yet perhaps more profound, structural shift in the architecture of global power underway. This was articulated by the new chief of the United Kingdom's Secret Intelligence Service, MI6, Blaise Metroelli.
Her warning represents a fundamental challenge to the state-centric model of power that has dominated international relations for, well, centuries.
What was her core message?
She warned that global power is progressively shifting away from states and toward technology companies.
Why?
Because these massive digital platforms and their underlying algorithms are the things that increasingly influence international security, governance, and even military outcomes.
We tend to think of power in terms of missiles or GDP or the number of troops. She's pointing to code and digital infrastructure as the new currencies of control.
Exactly. The core of her argument rests on the ubiquity and, crucially, the dual-use nature of cutting-edge technology. Metroelli highlighted that AI-driven robots and drones tools developed largely by the private sector for efficiency and automation in, say, a warehouse are, in her words, brilliant for large-scale production, but devastating on the battlefield.
And the private sector holds the intellectual property and the expertise. The states are playing catch-up.
And they can't catch up. The technological leap is happening at a speed that governments cannot possibly match or regulate effectively. She used another compelling example. Medical advances that are capable of curing diseases can also, conversely, give rise to new biological weapons. And that knowledge base is diffuse. It resides in corporate labs and university research parks, far outside the traditional control mechanisms of sovereign states.
So the ultimate safe haven of power is no longer guaranteed to reside within the sovereign state. It could reside with a powerful tech CEO or a corporation that controls the most sophisticated dual-use AI algorithm.
That's the critical implication here. In contrast to the traditional state-centric model, control of these complex, powerful technologies makes power more diffuse. It's less geographically constrained, and it's inherently unpredictable. It transfers actual operational capabilities, the ability to disrupt, to monitor, or to attack from governments to corporations, and in some cases, even to highly skilled individuals who are not affiliated with any state.
We are entering an era where sovereignty might be defined less by your borders and more by who controls the most powerful algorithms.
It's a world where a coordinated deepfake campaign, facilitated by a tech platform, might destabilize a major election more effectively than any conventional military mobilization.
The very nature of conflict itself is changing.
It forces every government, every military, and every financial institution to redefine who they consider their peer, who they consider their partner, and most importantly, who they consider their primary threat.
What a synthesis of volatility. We started with that deep financial ambiguity in the United States, where the Federal Reserve is effectively paralyzed by noisy data and high real interest rates. And we saw how that monetary environment directly triggered a massive 50% shift in the Bitcoin to gold ratio, forcing investors to reevaluate physical gold as the superior safe haven against systemic geopolitical risk.
And then we examined Central America, an extraordinary test case where this intense state security centralization and aggressive digital asset adoption are being deployed together to try and overcome these immense, persistent structural labor and pension deficits.
And finally, we saw the global security landscape being completely rewritten. Governments are fighting new wars, classifying fentanyl as a weapon of mass destruction just to unlock military-grade responses against non-state actors.
But while simultaneously receiving these high-level intelligence warnings that the ultimate source of global power is migrating, moving away from capital cities and into the hands of autonomous algorithms controlled by private technology companies.
The recurring theme across every single section is this challenge to the traditional metrics of stability and control.
Absolutely.
Whether it's the collapse of the correlation between gold and Bitcoin, or the tension between a sovereign nation's crypto holdings and its pension debt, or the transfer of battlefield power to corporate code, the old systems of measurement and control are being fundamentally destabilized.
Indeed. What we're really seeing is a race. It's a race between state efforts to reassert stability, often through centralization and hard power, like the WMD classification or those intense security reforms, and the organic decentralized spread of power and capital, which we see in things like the gold rush and the diffusion of technology.
So what does this all mean for you listening? If governments and central banks are desperately seeking the traditional, tangible security of physical gold to hedge against geopolitical risk, Yet the true existential threat to global stability is rapidly migrating into the hands of a few powerful tech companies who control these dual-use algorithms. Who ultimately holds the real safe haven of power in the modern world? The sovereign state, the decentralized asset, or the algorithm? Something to keep you thinking until the next deep dive.
We'll be waiting for the next stack of information.